Welcome to the What to Watch video update. This is the last video that I do over the weekend where I look at mainly the daily charts, but there's a few weekly charts in here as well. And I pull all those out and those that seem to be really telling us something right now, either positive, negative, and then a third area where these are things that we're just keeping an eye on because they can shift and change and that can have some impact on the S&P 500. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. This week, we are asking the question, will the S&P 500 keep setting new all-time highs? We did set a new all-time high on Friday. Now we're wondering, can we keep going from here? Or are we overbought enough? Are we going to come into the new quarter? The last day of the quarter will be on Monday, June 30th. And then will we see some selling? Now that's the negative side. The positive side is the first half of July ends up being about the most positive time of the year from a seasonal perspective. But we just came through some difficult seasonal times and the market did good. So we never use seasonality as making the decisions that we need to make. We follow the charts to do that. We just use it as kind of a guide. But it does look like if we do stick to seasonal norms, we could see some positive action, at least for the first few weeks of July. And then things tend to level off later in July and actually turn a little bit more negative, with them turning quite negative seasonally in September. But hey, let the good times roll for right now if they're going to continue. All right, first I go through the positive side. We had an up week, and really we just kept going up as the week unfolded. Of course, a week ago we had the bombing that happened in Iran, and there was real uncertainty about, okay, what's going to be happening with that? Is that positive or negative? Oil was really going up, and it looked like, okay, Sunday afternoon or evening, what's going to happen with the futures? Well, we ended up doing okay. And we just kind of kept going up from there. Then we also gapped up on Tuesday. Now, one thing that's a little bit of a concern here is as we're going up, you can see volume tends to drop off. And that's kind of a classic negative divergence. But we've been able to hold on to the gains. And so we ended up coming down a little bit here on Wednesday, but then coming up off of the lows. Then it was really Thursday and Friday when things started to show some more conviction to the upside, and we actually are starting to trend now with the S&P, where we spent the last number of weeks not trending. And we did, excuse me, gap higher on Friday. We did set the high about partway through the day, and then some news came out from President Trump saying, oh, Canada, we're not going to talk to you anymore. We'll tell you what your tariff rate is going to be. And that produced a decline here, which could have just turned things. And we had the core PCE come out, which was showing inflation had gone up and spending is going down. The market could have just tanked on that, but it didn't. The buy the dippers are coming in. We set some support up here at the daily pivot, and then we're able to close up back above R2. And I update these R2, R1, S1, S2 levels. I update them every day on the YouTube community tab. For those of you that are members of the program, it's included as part of the newsletter that I send out every day as well. All right, then looking at the daily chart, the dashed line here, this is the previous high that was set back in February. It was February 19th earlier this year. And we were able to surpass that not only on an intraday basis, but on a closing basis. So we've now taken a round trip where we hit the high in February. We were down on an intraday basis over 21%. We finally hit some support, bounced up off of that. And it's been difficult because we come up and the market is so emotional in this area. It's like, are we going to go up or are we going to go down? And there's all these geopolitical things going on that are big variables out there. There's the beautiful big bill that, as I record this, the Senate has now decided to vote on that, and they're likely to pass that. But then it might go back over to the House because there's been some changes made to it with the goal of this being on President Trump's desk July 4th so he can have a ceremony on Independence Day. But we have really done a pretty big, excuse me, a pretty big round trip here, and we're now back to setting new all-time highs. We're not quite at an uptrend yet. You can see the blue line is still a little bit below the red line. Now we are seeing it, and when this crosses, that's called a golden cross. We did see a golden cross with the NYSE, and we did see a golden cross with the Nasdaq 100, which that's the big growth area, which those stocks are also included in the S&P. So we're seeing a lot of improvement here. The market is turning more offensive, but about the time the majority of folks just say, well, it's going to go up automatically, it doesn't mean the party is over. It just means the party might be getting close to being over. The market will not be taken for granted. It likes to climb a wall of worry, and this was a pretty big wall and a pretty big area of worry for the market to be coming back up. So hindsight, yeah, okay, should have got in down here, and now we're looking pretty good. But what was going on during this time? Crazy stuff. And this was all the trade wars, and you had all the perma bears out there just declaring that this is beginning of a crash that's even going to go lower. Even when we started to bounce back up, there was really not a lot of overall confidence that we're going to continue to go up. But the market has been able to claw its way back up and look a little bit better. Also, I update this every day on the community tab on the YouTube channel as well. These are daily pivot points, and they last for the whole month. And now they're going to kick into gear on Tuesday when we start the new month of July. So these other dashed lines that you see, which had been acting as resistance, these were the pivot points for June. And now we can still latch on to previous pivot points. That happens quite often. But that's what you see with these additional markings that are on here. And the neat thing about pivot points, not only the intraday ones, but here the daily ones, we see these ahead of time. So we know they're there. And the market tends to really use those pretty heavily. And then in Friday's session, we saw a real spike up in volume. We've seen a few days here where volume really picked up, but for the most part, it's been below average still. All right, then we're still looking okay here. We have an intraday chart of growth versus value. The blue line is growth. The red line is value. They're both going up. And when growth is outperforming on an intraday basis, we see the blue line above the red line. And that's really what we're seeing here. Then we look at an intraday growth to value ratio for the S&P, where we were coming up out of the April lows where we were going down ferociously, but that's now off the chart. We did start to come back up. And this is where we were starting to get a little bit more positive on the market. But then we hit June and we pretty much have been going sideways. Now we're starting to break out again a little bit more to the upside. Now we look at small cap growth to value. It pulled back in Friday's session, but we're still above the moving averages and up and in an uptrend here. Mid cap growth to value also in an uptrend. S&P growth to value also looking pretty good. Not breaking out to a new high yet, but still showing a lot of improvement. And when these ratios are going up, the market is going up as well because growth is outperforming value. And we also look at a growth to value ETF, breaking up out of the rainbow, but not back to the previous high. Now you could say, oh, there's a negative divergence. We're setting an all-time high with the S&P, but we haven't set an all-time high with this ratio. Okay, but you could also say, all right, the market's been so confused and so emotional and driven by geopolitical events largely, and then news about the tariffs and trade wars, that maybe there's still room to run to the upside here. So there's a positive way and negative way to look at these charts. We look at our growth to value ratios. We're still looking pretty good with the Qs to S&P above advancing moving averages here. And we're seeing the same thing with large cap growth to value. Where we're improving but still lagging is discretionary to S&P. This is Tesla. That's been a big drag on the discretionary sector. If Tesla could continue to go up and show some improvement, and Amazon's in here too, and get back above the moving average and see the moving average turn back up, we would see more confirmation across all three of these charts. We're also looking okay when we look at the large caps, mid caps, small caps lagging a little bit, but they're still above the moving average with their growth to value ratio. Discretionary, this is where we're talking about with Tesla having more of a drag here. We've held up okay. We came right down to the 200-day moving average with this ratio, and we've held above that for right now, and we are improving, but we want to see this continue to go up to be even more positive. Then we have large cap growth. This is looking good above all the moving averages, setting a new all-time high in Friday's session, not on an intraday basis, but on a closing basis. And then those stocks in the S&P above their 20-period moving average were above 50 and advancing. That's positive. We're positive, and we've been holding up better with the intermediate term. I use that based on 50 periods. And even when we were kind of going sideways, we weren't seeing a lot of real movement here. It was mainly in the short term. And that's more positive too. When you have consolidation going on where we're still doing things above the 20-period moving average, that's considered positive as well. The 100-period moving average is still positive above 50. This is positive here with the 200-day moving average study, but also a little bit concerning. Here we are at an all-time high with the S&P, and we only have 55.2% of the stocks above their 50-period moving average. That's the negative side, that we're seeing a bit of a negative divergence there. But at the same time, if the broader part of the S&P kicks into gear and starts to go up, this will go up as well, and that could be more positive, meaning that there's more broad participation. It's not just a few of the AI stocks and mega cap stocks and the growth stocks that are really controlling things. Then we look at a cumulative advanced decline line based on price, for the S&P here. We are setting a new all-time high. We've been setting new all-time highs based on volume, and this is positive as well because we're seeing volume actually leading price. Volume's going up faster than we're seeing it with the price, and that can end up being quite positive. And we look at a 50-period moving average of the new highs, new lows. We're above zero and going up. This is longer term, and this is showing the internal strength of the S&P, and that's continuing to look better. And we keep an eye on sentiment. Now, a week ago when I did this, we were going down with sentiment, and we tend to go with that, whatever direction it's going at any given time. Well, we're starting to go back up now, and so now we're looking at this in a more positive way. Where we start to throw up some warning flags is if we get close to the 75% level. So we're still positive right now, but not extreme positive. But if we do get up to this level, that means the market's getting a little too exuberant about things, and we say, okay, it's becoming overbought. We look at other charts and say, maybe we're due for some kind of a pullback. All right, then the VIX is below 20 and declining. That's more positive for the S&P, and the momentum for the VIX is now going down as measured by the MACD. That's positive. We're seeing the risk on to risk off ratio continuing to go up. That's more positive, and we're setting a new high with this ratio. High beta, this is Nvidia, Google, Apple, Netflix, those stocks. Not at an all-time high yet, but when this ratio is going up, that means the market is more positive. And when this ratio is going down, that's more positive. This is value, and then we look at tech, which is the biggest area, a huge area of growth, if not the biggest area. And so with this ratio going down, that's positive. So we're seeing some confirmation there. Now, this is something that was looking pretty bad there for a while, but now seems to be improving. This is the SPY to Staples ratio. And to give you an example of that, right at the end of 2021, we were really going up with this ratio. It's like the market's never going to go down. It's just going to keep going up. We had all this stimulus coming into the market after the COVID crash and the lockdowns and everything. But then we started to roll over at the end of 2021 with this ratio, and we just kept going down. Now, we set the all-time high at that time with the S&P 500 in early 2022. There was a bit of a lag here. And then we went into a bear market, and we didn't bottom until October 2022. And this ratio was going down during that time. And then as we were getting closer to a bottom. It took till the end of, actually the early part of 2023 for this ratio to really start improving and then turn back more positive. Well, we were really coming down after setting a high with this ratio, and they're going, okay, all right, this is not looking good. Is the market falling apart here and just giving us a warning? Because this high was set before we set the all-time high with the S&P last February. This high was set back in January. And so this was one thing that we were watching. Well, because things bottomed and are starting to go back up, we're seeing a real improvement now with this ratio and is actually turning more positive. Then we look at the advanced decline line based on price, setting a new high here. Price setting a series of highs recently based on volume. We're above zero and going up with the 10-day advanced decline oscillator here. Now, again, you could maybe go, wait a minute, how come we're at an all-time high for the S&P and how come this chart isn't higher than it is? That's a valid concern. That produces a bit of a negative divergence. But it also can mean that there's more room to run to the upside if we see more stocks in the S&P start to participate. And looking at new highs, new lows, we're seeing a real expansion of the new highs, really no expansion of the new lows. We're flat, but trying to turn back up with the 5-day moving average, where we're starting to go back up with the 10-day moving average. So the internals are looking pretty good here. Then we have three smart money indicators. The first one is accumulation distribution, above the moving average and advancing. And then this is shorter term, the boom indicator. It's also advancing above its moving average. Smart money indicator on a weekly side for accumulation distribution, we are still above the moving average. So we're seeing some confirmation there longer term. Now, smart money indicator number 2, we're starting to go back up with the Chaikin money flow. The red line has turned up and the histogram is going up. And then the Chaikin oscillator is positive. Even when we were having some difficulties earlier in the week, this still kept going up. So that's a pretty positive sign there. And the vortex, another primary indicator, is above zero here with the green line and going up. The red line ticked up a little bit, but we're still seeing the green line above the red line. That's positive. And now we're finally starting to trend. We saw the ADX Thursday. It finally started to turn back up and go above the moving average. And so now this shows a strengthening trend, and it's positive because the green line is above the red line. It's not a confirmed trend until we go above the static level here of 20. So it's not confirmed. Some of you may put some importance into that. Others go, wait a minute, I'm just happy that we're going back up now and we're above the moving average. But this is the short term. Now we're also turning back up and looking positive in the intermediate term. And this is the one that I focus on the most. Green line going up, red line going down, above the moving average going up, but we're still below 20. Now we look at the condition of the short-term trend based on 20 periods, getting into a little bit of trouble here a week or so ago. But then as things were coming out geopolitically that were taken as more positive, we're starting to go up here, and the green line and the blue line are going up. Then the condition of the intermediate term trend, it really didn't take much of a hit. You can go back to this one. You see where we're kind of bouncing around because this moves a lot faster. We were much more smooth. Even though we were pulling back based on 50 periods, the red line is going up and the blue line is going up, and we're actually acting as support here with the double exponential moving average. Then I plot all the moving averages together, and we're above all of them, and all of the lines are pretty much starting to go back up, and so that's positive there. But we're possibly too far away from some of these moving averages. The boom indicator measures price in relation to the 20, 50, and 200-day moving average. We use this like an oscillator. Now, when we get above this 100 level, that's where we're getting kind of far away, and the moving average tends to act like a magnet or a rubber band and can often pull price back to it. Now, it's positive. That's why it's on the positive side, but maybe a little too positive. We're also getting far away from the 50-period moving average. We're not far away from the 200, and that's, as I pointed out earlier, a little bit of a concern, but we are above zero and going up with this indicator. Then we look at the S&P McClellan oscillator. Again, you could say, how come we're not higher than we are right now, even though we're setting an all-time high with the S&P? Okay, valid concern, but we are above zero and improving. And when the McClellan oscillator is positive, we're going up with the summation index based on price. Even when there was a day or two this past week where we started to go down based on price, we still kept going up based on volume. That also is showing that the volume is tending to lead price right now, which ends up typically being positive. But we are advancing with both areas of this chart. Then we look at a broad market measure, the NYSE McClellan oscillator, also above zero. So we're still going up, and see how choppy this has been lately. But we are going up with the summation index based on price. We're starting to turn back up here based on volume. Swelling trending oscillator above zero and advancing based on price and volume. That's positive. Now, we're positive here with the percent B indicator. These are Bollinger Bands, and there's thick books written about how to use Bollinger Bands. This is just one implementation of that. One thing that I was noticing a week or so ago, the Bollinger Bands were starting to get kind of close to each other. And that usually means that it's like a spring that's being wound up. And then we didn't know, were we going to break to the upside or break to the downside? Because things could have been bad a week ago just as easily as they were ended up being good. But we ended up breaking to the upside. In fact, since the Bollinger Bands are so close to each other, we spent the last few days above the upper Bollinger Band. And that tends to not happen very often. You can see other times when we get a really high reading like that, and it tends to not last very long. You can see we don't really camp out at these areas. Now, what will have to happen here is we either come down with price to get back inside the Bollinger Band, or the Bollinger Band keeps going up, or a combination of the two, which brings us back down more into the range with the Bollinger Band. But for right now, this is taken as positive, but a bit of a concern. This is showing that we're overbought with this chart. And we're starting to get just barely overbought with the RSI 14. I usually don't show this chart in this video. As important as RSI is, I use it as a secondary indicator. I don't use it as a primary indicator. But Bloomberg came out with a chart, and this was before Friday when we were just below 70. And they're like, uh-oh, major warning sign. We're hitting an overbought condition. Well, I wanted to address that here. Just because we go above 70 doesn't mean we're going to automatically turn and go down from here. There's times when we spend a lot of time above this 70 level. It's not an official overbought condition until we go above it and then come back down and drop below it. So we could still go up from here. Now, down on the bottom, this is a shorter term RSI, and we're above 70, and we've been there for a few days. So yeah, be aware of this, and this could signal that we're overbought when you combine that with the percent B indicator that we just looked at. But it doesn't necessarily mean that we're going to turn on a dime either. It could mean that, but we're looking more positive now until proven otherwise. Then parabolic SAR daily chart is positive. It spent 3 days being negative. Then we had that gap higher on Monday, and we were able to come up from that. And the weekly parabolic SAR chart also still continues to be positive. So we're seeing some confirmation there. And we're improving with the short and intermediate term oscillators. We're turning back up with the slope, but we're already extreme positive. The TSI, the other short-term oscillator, is now looking positive. We're starting to cross back above the moving averages here with the intermediate term oscillators, the MACD, the PMO, and PPO. We're still negative, though, with our long-term oscillators because they take longer to move. We are flattening out here with the tricks, and we're still declining with the KST. So to see more confirmation and that we're seeing longer-term upward movement, we need to eventually see these long-term oscillators turn back over and go positive. And we are going up with the bullish percent index. We're just a little bit below the 70 level. If we go above 70, that's when we're starting to get extreme positive. And we're going up with the NYSE bullish percent index, and we dropped down a little bit, but we're just slightly above 70, looking extreme with the NASDAQ 100 bullish percent index. And we had enough of an upward move here so that we were able to draw in a new X in Friday's session. We had a couple of X's on the weekly point and figure chart. I'm just showing the daily chart here. And this is a triple top breakout that was actually generated back on June 6th. So this is looking more positive as well. And then this was when we were going down. And these longer blue lines, these are up positive trend lines here. So we're still looking positive with this chart. And we're looking good here. The weekly chart of the S&P, we were up 3.44% for the week. And we're looking fairly constructive here. If you go back to the lows, we're seeing a series of higher highs and higher lows as we've been coming up out of this and, and coming back up and setting a new all-time high. And when this ratio is going up, this is the S&P to utilities ratio. That means the S&P is outperforming utilities. So that's positive. And when this ratio is going down, that's positive. Staples are underperforming the S&P. Staples are more defensive. This is the earlier chart that I showed. When staples start to outperform, that's usually negative for the market. So this ratio going down is more positive for the market. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. And we look at different advanced decline lines, and we're above all the moving averages here with all the different indexes that we follow. Even the small caps are showing some improvement. And then we look at the common stock on the NYSE. First of all, based on price, we're not back to an all-time high yet. Now, that can be taken as a negative divergence, but when you look at volume, we are setting a new all-time high here. So volume could be leading price higher. So that could end up being positive as well. And then we look at a broad market measure, looking at the Amex, NASDAQ, and NYSE, and then we take a 5-period moving average of the highs minus the lows, above zero and going up. This is showing more broad market strength internally that continues to improve. And then I usually don't show this chart either, but there's what you call Dow theory, which is developed by Charles Dow back in the 1800s. And if the Dow makes a new all-time high, you want the transports to make an all-time high at the same time. Well, some folks have come along and said, well, the Dow, it's only 30 stocks. Let's not use the Dow. Let's use the S&P 500 instead, where it's making a new all-time high. And instead of using the transports, my goodness, we've got technology now. Let's use the NASDAQ instead. It is now making an all-time high here. So if you use this way to measure things, this is a positive confirmation. They're both setting new all-time highs at the same time. The Dow is improving, but still has a ways to go to get back to its all-time high. It was having a really difficult time staying above its 200-day moving average. And some earnings came out this past week that really helped the Dow to go up. The NASDAQ getting really close to a golden cross, setting a new all-time high. So this is looking better. The NASDAQ 100, these are the biggest stocks that are in the NASDAQ. We are seeing a golden cross here, setting a new all-time high, and that helps the S&P as well. And we're turning back over to positive with the momentum of the NASDAQ 100, where it was continuing to drift lower, and now it's starting to go back up. And small caps, I have them on the positive side here because they were up. They're still below their 200-day moving average. They're still in a downtrend, but they're barely just breaking out of the top of this range that we've been in for a while. Now, one thing that's been really frustrating with small caps is we have this big up move and then a pullback, a big up move and then a pullback, a big up move and a pullback. Is that what's going to happen here? Or are we going to see some more follow through to the upside with the small caps? Here's the Russell 2000. Now, this is the previous chart. This is the S&P 600 small caps. This one is the Russell 2000 small caps, probably more popular as an index. And this was really having a difficult time getting back above its 200-day moving average. Well, we did that not only on Thursday, but we were able to hold on to that on Friday. So this is actually starting to break above what had been resistance. Not turning positive yet, but showing a lot of improvement. Mid caps also finally able to get back for the last 2 days above their 200-day moving average, but still in a downtrend. Small caps and mid caps have really underperformed in 2025. We'll see if that's going to change. Now, a broad market measure is the Wilshire 5000. We've been above both of the moving averages, setting an all-time high here on a closing basis, getting really close to a golden cross being generated. And another broad market measure is the total U.S. stock ETF, getting close to a golden cross, setting a new all-time high. That is positive for the market. Then another look at that same ETF, only using a rainbow here. where we're coming back out and setting a high, and 70% of the weightings are outside of the tech sector. So this is positive because it's like, well, tech's the only thing really driving the market up, and it is helping the market, and semiconductors are helping tech. But this shows that most of the weight of this particular ETF is not tech. So this is showing more broad market participation. Financial sector, it never did go into a downtrend when we were really headed lower back in March and April. It's not quite back to an all-time high yet, but it's still holding up quite well. One area that we're a little bit concerned about is the ratio between the financial sector and the S&P. I pointed this out a week ago. I've been watching this chart every day. We came right down to the 200-day moving average with this ratio, and so far we bounced up off of that. It would be even more positive if we could start to go up with this ratio and actually have the financials outperforming in the S&P. FANG index setting an all-time high in an uptrend. These are the really big stocks. And then the staples to tech ratio is going down. That's positive. That means staples are underperforming the tech sector. And then we do some ratios between stocks and bonds. We look at the S&P 500 and 3 to 7 year bonds, and we're coming up out of the rainbow and have really been improving here. And when we're above the rainbow, that means the market anticipates that there will be a soft landing, meaning no recession. When we were really screaming to the downside here in March and into April, the market was afraid, uh-oh, we're going into a recession. The tariffs are going to produce inflation. Everything's going crazy. The perma bears were just partying every day, just declaring that life as we know it is over. And then we hit a bottom and then are coming back up out of that. So we are showing more of a positive slant with this chart. And you're going to see a lot of the same thing as I go through the next series of charts here. Other than this one, because this is an inverted version of the chart. This is that same chart, but showing how bonds are underperforming stocks. Now you're going to see a lot of the same things. The S&P 1500, a broad market measure with short-term bonds coming up out of the rainbow. A broad market measure, 3 to 7 year bonds coming up out of the rainbow. Tech sector to 3 to 7 year bonds, not quite back to an all-time high, but really showing an improvement there. The Qs, the NASDAQ 100 to 3 to 7 year bonds, looking much improved. And then this is positive because we're going up with the NASDAQ 100 and setting new all-time highs. But this is a trend line going back to 2009. And I drew this on here, so it's not absolute by any means. But going from the 2009 low and then connecting these lows back in 2016 and then just extending the trend line forward, we're hitting the upper end of this trend line. Now, we could still go above it. We did that back in 2024. But we just want to be aware of this, that on a long-term trending basis, maybe we're starting to get a little bit overextended. Or we could just break above this and then continue to go above it like we did back in 2020 and into 2021. Then looking at the growth versus value ratio represented by the NASDAQ 100 and the Dow, above the red line and going up. That's positive. The Qs, NASDAQ 100 to small caps, above the blue line and going up. That's positive. The tech sector, just looking at a rainbow chart here, setting a new all-time high, even though it was down a little bit on Friday. It set the high on Thursday. This is looking much more improved, and this is a huge part of growth. And then semiconductors, starting to see a golden cross here with the Dow Jones Semiconductor Index and setting a new all-time high here. And then we have some other ones that are just about ready to generate a golden cross with the SMH Semiconductor ETF, but not quite back to the all-time high here, but really improving. That same ETF, but showing how it's coming up out of the rainbow. And then we look at a ratio, the semis to tech. And we want tech to do well. It's setting all-time highs. But when this ratio goes up, that means semis are doing even better. And that's more positive, similar to what we saw at the beginning of 2024 when this ratio was just screaming to the upside. Now, we can still go up with this ratio going down. If you remember back about a year ago, this ratio topped out in the summer and then started to drop off. We were still going up with the S&P. I remember some folks were declaring, oh, this fall is just going to be terrible, awful. Well, we just kept setting a series of new all-time highs there. So we can go down with this ratio, but it's even more positive when this ratio is going up. Semiconductors to Dow, I actually have this for the first time in a long time on the positive side because we were coming down showing that semiconductors were underperforming the Dow, and we were setting a series of lower highs and lower lows. That's bad. Now we finally broke out of that pattern and we're starting to improve and we're getting closer up to the blue line. That's why this is now on the positive side. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Now we go over to the negative side, and there's not a lot of things negative right now. This is a long-term oscillator, and it's been negative now going back to about the early part of March. I don't show this chart in the daily videos because we didn't get it. The last signal before this was in late 2023. So I just show it in the deep dive video that I do, and I often show it in this video as well. We're still negative on the daily side with the special K. This is a very long-term oscillator. We're still positive on the weekly chart that I don't have here. And this was positive, but the context is that we've been going down lately, and I had to have something to put on the negative side. This is a 10-day average of the highs and lows for the S&P. When we get above the green line, that's showing longer-term, broader participation strength. And we were up there, but then we started to just drift down. Now, it bounced a little bit up on Friday, but the context is that this has been declining. But this is a longer-term indicator as well. And we just saw the strength in Thursday and Friday's session, mostly. Even though we were up on the week, we saw more conviction on Thursday and Friday. And so the hope is that this will eventually turn around and start to go back up. But until we see that happen, I'm treating this more as negative, since for the most part, this has been declining. Then we look at the long-term trend of the S&P. This is a weekly chart. We're positive in the short-term daily, positive in the intermediate term daily. We're just barely negative here. We're seeing the red line coming down and the green line coming up. And this is a weakening trend. Now, if we have another up week and the green line crosses above the red line, this will be over on the positive side. But we have to take it for what it is right now, and we still see the red line above the green line currently. Now, when I talked about the new way of looking at Dow theory, using the S&P instead of the Dow and using the NASDAQ instead of the transports, here's another variation of that. Let's use the equal weight version of the S&P instead of the S&P itself. You notice we did not set an all-time high back in February. The last high was set back in 2024. Now we're doing good here, but we're not setting an all-time high with the equal weight version of the S&P. That's why this is on the negative side. Now, if this can continue to go up, that will mean that there's more broad participation. Now, instead of using the NASDAQ, let's use an equal weight version of the QQQ. This is close, but it's not setting a new all-time high, where we've been seeing a new all-time high with the NASDAQ 100. Not a huge deal right now, because as long as the bigger stocks are really leading the way higher, that helps the S&P to go up and makes things more positive. This is just to show us that it's not all the stocks in the S&P that are really driving things up. If we see a switch in that, that would be more of a broad market participation. And then home construction to 3 to 7 year bonds, kind of chopping along sideways lately. So it's improving a little bit, but it's negative. This was one of the better looking areas going back to 2023 and into 2024. It had its moments, but it spent a lot of time above the rainbow. This started to break down as we got into the latter part of 2024. And this was giving us a warning sign that, not all is well these days. And this ratio just kept going down. It actually was leading to the downside before we saw stocks really start to fall. Now we are kind of building a base here, but it would be more positive if we could start to go back up with this ratio. And this area, this home construction, very interest rate sensitive. So if interest rates start to come down and this starts to go back up, that would turn this back and looking more positive. Then some areas that I'm just keeping an eye on. We want to keep an eye on jobless claims, which actually declined. So on a short-term basis, the employment situation is still holding up. Now, in Thursday's session, we're closed on Friday for the 4th of July, but in Thursday's session, we're going to get the employment situation report. And that's the biggest economic report of the month. So we'll see, how's that holding up? But the initial claims, they are actually declining and the moving average is starting to go down. But this is a little bit of a concern. These are continuing claims. These are folks that are unemployed for longer than a week. This continues to go up, and we'll have to see how this starts to play out as well. So shorter term, we're looking okay, but a little bit further out, it's like folks aren't getting unemployed as much, but those folks that are getting unemployed are having a more difficult time finding another job. And then I put all of them together here on this. We'll get an updated reading on the unemployment report in Friday or Thursday session. Then we are a little bit concerned. For the most part, we've been below average with volume. Now we did spike up. Now we're likely to see a spike up in volume on Monday because it's the last trading day of the month and the quarter. And there's likely some window dressing going on for quarterly reports and monthly reports. But we saw a bit of that happening in Friday's session where we saw a much greater volume than we've been seeing lately. And then this is just something to be watching. This also goes back into that scenario when we see the weighted version of the S&P setting new all-time highs, but the equal weight version, it's improving and it's going up, and that's good, but not necessarily performing as strong as we're seeing the S&P weighted index. Seeing that same thing here with the ratio. When this is going up, that means the S&P is outperforming the equal weight version of the S&P. And we're just watching that because the market can still be positive even if that's happening. Now we are below 4.5% with the 10-year yield, and for the most part we've been coming down, and that's really been helping stocks to go up. And then these are areas to look at to say, okay, is the market concerned about inflation? You can listen to all the YouTube videos you want talking about how inflation is going to go through the roof or inflation's never going to happen again, whatever. What I do is I look at the charts to tell us, and I look at a number of different time frames, and I look at different instruments. This first one is cash, which is 1 to 3 month T-bills, because you get like no interest with that. And then doing a ratio with 3 to 7 year bonds. Now, when this is going up, like it was back in 2023, and it's like, okay, we're kind of concerned about interest rates going up, and we're concerned about inflation going up. Well, look what's happening now. We're actually going down with this overall ratio. This chart in the short term just says the market's not really concerned about inflation. And we use TIPS, which do adjust for inflation. They're Treasury inflation protected securities. When the market thinks interest rates are going to go up and inflation is going to go up, they start getting into TIPS and they start to outperform 3 to 7 year bonds. When we top out with interest rates and the market feels like, okay, we hit the highest rate that we're going to get there, so now we're going to jump over into 3 to 7 year bonds and lock in that longer term rate. That's when we see this ratio going down, and that's what we've been seeing lately. This suggests that there are no inflation worries right now, according to the bond market. And we look at TIPS again and look further out at bonds, 7 to 10 years. Also, the ratio is continuing to go down for the most part. And then another thing we want to keep an eye on are the yield curves. Now, this yield curve is fine. This is the 10-year to 2-year, and it's back to being normal. It's above the blue line, looking okay. Most people follow this, but then I also follow another one. This is the 10-year to 3-month yield curve, and we're dancing between going inverted and not being inverted. We're just a little bit inverted after Friday's session. And this can produce some inflationary, not recessionary fears looking down the road a little bit. So we just want to keep an eye on this one. And then we look at the spread between risky bonds like junk bonds and government bonds, more conservative bonds. And this is an inverted chart, but when this is going up, that means that there's the fear is coming out of the bond market. And that's pretty much what we've been seeing here. And we would keep an eye on the ratio between gold and the S&P, where as this has been going down, that means gold is now starting to underperform the S&P after gold had really been outperforming it. Notice how we came right up to this trend line between these previous spikes and then started to come down after that. Want to keep an eye on retail. Now, looking at the middle area, we're doing okay here. We're above both of the moving averages. The green one here, that's the 200 period moving average. We're not quite into an uptrend yet, and we're above 50 with the RSI. Where it's underperforming is when we compare it to the S&P. And this has been going down now for quite some time, going back to early 2021. So it is underperforming. Again, retail is such a huge part of the U.S. economy. We want to keep an eye on this. And then we look at different ratios. The top one is a weighted version of discretionary versus a weighted version of the staples. And this has been going sideways and starting to improve. Then we look at an equal weight version of discretionary to staples, and this is also improving. The two big stocks here are Tesla and Amazon. We want this to continue to go up because this has been a lagging ratio that we've been seeing as discretionary has been lagging in 2025. We're seeing a bit of an improvement here with the tech, which is growth to utilities. Also, kind of going along sideways here when we look at biotech, which is growth, to healthcare, which is value, or you have to have it, more defensive. And we're also seeing a bit of an improvement now when we look at a ratio between hotels and utilities. Hotels are discretionary, utilities are something that you have to have. And we keep an eye on this to see, okay, and then I'll pull these out and use them in the daily videos if we really start to see something develop here, either positive or negative. We also keep an eye on what are considered to be the bellwether industries in the U.S. economy. Semiconductors looking pretty solid here. Home builders doing better, but they've been under a lot of pressure. Transports trying to break out, but they've been disappointing over the last couple of years. Going sideways here with retail, we just looked at the full chart for that. And then the regional banks trying to improve as well. It's just going to be a lot better if we see these other areas start to see more of a solid uptrend. Oil, which a week ago was getting up into the high 70s on an intraday basis, we've dropped all the way back down to the mid 60s. And the dollar. And now there's some talk out there that maybe there's some manipulation going on, that they're purposely making the dollar weaker to help the stock market go up because the stock market does like a weaker dollar. Well, it's in a downtrend, and at some point, the dollar is likely to become oversold and then start to bounce when compared to other currencies, but it's not looking like it's happening yet. So we're just watching that for right now. And we look at momentum stocks, which had held up better as we were coming back up out of the lows. Lately, they've been kind of going a little bit sideways as the momentum has been shifting from defensive areas back over to more growth areas or offensive areas of the market. So we're seeing a little bit of a lag here. And then the German DAX, just because this is the biggest stock market in the EU, and it's coming off of setting a recent all-time high. It pulled back to its 50-day moving average, and now it's starting to go back up. Now, usually I don't pay much attention to this, but we've been seeing since the beginning of 2025 where the U.S. stocks, as measured by the S&P, they've been really underperforming the German DAX. And that's when this ratio is going down. Then we saw a big spike up, then we're coming back down. In a general sense, we're starting to see an improvement. And if this ratio continues to go up, that means that U.S. stocks may come back in and start to be the leader when it comes to the stock markets globally, especially between the U.S. and Europe. And emerging markets had been underperforming developed markets. Developed markets would be the US and mainly Europe. Well, we're starting to level off here a little bit, seeing a little bit of improvement with this overall ratio. And then these are the pivot points for Monday's session, which I update on the YouTube community tab. I just included in this video just so you get an idea what this looks like, and they're pretty important to follow. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.